If I told you that a company had grown sales by almost 20% a year over the last 3 years, had one of the most powerful brands in North American retail, invented a new category of clothing that has swept across the world while boasting 59% gross margins, industry-leading operating margins, and a 5-year average return on invested capital of 35%, I suspect you'd be pretty shocked to hear the stock is trading at just 15 times earnings.
Retail has always been brutal though, but yeah, I hear you. A correction in Lulu stock was warranted as growth has started to slow and tariffs complicated things, but Mr. Market seems to have really excessively soured on a great company after what really has been the first signs of trouble.
With almost all of its sales coming from DTC rather than wholesale, Lulu controls its brand and destiny in a way that few other brands can. To say nothing about the success they've already had expanding in China. This may soon be much more than just a North American brand.
Today's pick is a company that most in North America will know. It's Lululemon. In the last year or two, despite this being a company that has compounded revenues at north of 20% a year for the last 5 years, with industry-leading margins and returns on capital, the stock has fallen from a PE of almost 70 to just 15. That's the kind of contraction you would expect from a company where something is seriously wrong. And while Lululemon, as a premium active sportswear brand, is facing some headwinds, it's not like the business has imploded. By all measures, it's still growing with very promising prospects internationally and in e-commerce, even if sales in its North American market are finally showing evidence of stagnating on top of margin pressures from tariffs in the US. That is at least how you, Shawn, have described the pitch to me, a company with that kind of brand power, recent growth, profitability, and expectations for continued profitable growth for years to come probably should not be trading at just 15 times expected earnings over the next year. That's kind of crazy and places its valuation at a discount for brands like Skechers, which have had about half as much growth in the last few years, 6 percentage points lower gross margins, and less than half of Lulu's operating margin. So again, at a high level, the drop in Lulu's stock has been fairly shocking, but I'm just relying on the details that you've outlined to me, Shawn. So how about you give us a deeper dive?
Well, you did a pretty good job. I've been keeping an eye on Lulu at a distance for over a year now, since our colleagues Clay and Kyle first pitched it on We Study Billionaires, and the stock has just fallen so much. While the underlying business has continued to hold up, I couldn't ignore it any longer. And I think it's now down 20% from when I first thought it looked cheap last summer. So it also helps that I'm biased by the fact that I'm a fan of the products. That always makes it easier to dive into a company and get excited about it than, when we look at something like B2B SaaS and everything is just so much less tangible and relatable, especially if we've never used the products because we don't work in that niche. But before we do begin and get into Lulu, I just want to quickly say that we are going to be opening applications to our intrinsic value community of investors again soon. And our last cohort of 30 spots filled up very quickly. And so our next cohort will actually have fewer openings. So if you're interested in potentially joining what is a very active and special group of like-minded investors to discuss ideas weekly, you can join the waitlist for updates at theinvestorspodcast.com/intrinsic value community. And the link for that will also be in the show notes or the description below.
I think it's safe to say that we both had high expectations of the community, but the people we have in there and the calls we host, I think we both are very surprised on the positive side by just how it turns out. But now getting into today's pitch, where would you like to start in telling the Lulu story and making your pitch?
Let's start from the beginning. It's not an old company by any means, so we don't have that much history to dig through. Some people might not know this, but for as much as Lulu has come to dominate American clothing styles, the company was actually founded in 1998 in Vancouver, and then the first store in the US opened in 2003. And one of the things that made Lulu special was that they had figured out how to do these flat seams on yoga pants. And that removed a lot of chafe and discomfort on top of using very high quality fabric that was comfortable enough to wear, whether you're at the gym or at a local coffee shop working on your MacBook. And that sort of revolutionized what we now know as the athleisure market. And it used to be a lot more common that people, and I did this for years, wore their what you might call their worst clothes to the gym, whatever you didn't mind just getting dirty and banged up because, you were going to change into everyday clothes afterwards. It didn't matter what you were wearing, but Lulu changed that mindset. They made it popular to people who wanted to make a fashion statement and an identity statement when working out. So if your gym attire was cute and comfortable, maybe why not consider wearing it to Starbucks on the way to the gym? And why not keep it on during your ride home as you stop by the grocery store? And that kind of chic fit vibe became very trendy, especially here in the US. And it's now part of a more enduring style that has dominated for the last 15 years or so, where I would say wearing workout clothes anywhere has become increasingly acceptable. I know we've talked offline before about some of the crazy places we've seen people wearing, sports bras and leggings. And it's really feel like the boundaries have totally blurred. And so now Lululemon has over 760 stores in 24 countries, with about half of its sales coming from e-commerce. So this is a behemoth. And since IPO, the stock has compounded over the last 17 years at this really incredible rate of 17% per year, well faster than the S&P 500. And even with that recent drawdown in the stock, where Lulu shares have basically been cut in half since late 2023. And helping drive some of those returns is that on top of very profitable growth, the company has repurchased nearly $5 billion in shares since the beginning of 2017. And they've just consistently shrunk their share count, rewarding long-term shareholders with a bigger and bigger ownership slice. Though I will say some of these buybacks have been made at relatively rich valuations, which we'll probably talk about later, but that can destroy intrinsic value if it's done to an extreme.
The first thing that stands out to me when I look at Lululemon is just this insanely good margin profile. I guess that comes from Lulu having a special pricing power, and also just because sales have grown so much. That came with operating leverage. And so margins did just improve year by year over the last decade, really. And the company reported its highest operating margins in a decade in 2024, even if that is probably going to change this year thanks to tariffs. As always, we just cannot escape that topic, because when tariffs were first announced, Lulu was one of those companies alongside Nike that was punished particularly hard because they relied so much on China and Vietnam for production. But being able to sell at premium prices has really helped the company. Over the last 4 years, Lulu's gross margins have averaged 58%, so close to 60, well above its peers that average in the 45 to 50% range, according to Morningstar. As most listeners might know, Lulu's best-selling product is women's yoga pants, and these can easily cost over $100, with similar brands like Viori and Athleisure sell at roughly 20% discount, from what I've seen at least. And even though I'll be the first to say Lululemon isn't hugely popular in Germany, it's just not a brand that I know a ton about, but hearing about those numbers, it's just getting me excited about the pitch you're doing here.
I think Lulu really stands out in retail for its margins. It's almost unprecedented. The earnings profile is very high quality, and that is probably why the company felt empowered to lay out such an ambitious 5-year plan in its April 2022 Investor Day event, where they said they aim to double revenue by 2026, and that would namely be driven by increasing their sales to men, since this is a brand that has, as you kind of mentioned, historically earned most of its sales from women and specifically within yoga. So now that we're closer to this deadline, it looks like they're going to be a little bit short, maybe $500 million or so short of that goal, but still sales have very nearly doubled and they won't be that far off the mark. And they also wanted to quadruple international sales, and instead it'll probably be close to tripling. And it's, never good to fall short of those benchmarks, but it's not been too shabby either, right? The company is still growing very impressively in many ways. And its 3 priorities, as outlined at that Investor Day meeting, continue to remain product innovation, e-commerce, and international expansion. And I would say that last one is arguably their biggest growth opportunity, alongside continuing to boost menswear as a higher percentage of their overall sales.
They might have missed a bit about these, ambitious goals, but the 5-year revenue CAGR has been almost 23%, while generating a 35% average return on invested capital and boasting operating margins that are actually twice as high as our portfolio holding Nike. So I see why you're so impressed with Lulu's profitability, and honestly, I'm too. If you look at these numbers, there's just no way around it. And I should also say they appear to have very little net debt, over $1 billion of cash, so they are financially stable as well.
And yet the stock trades at 15 times their expected earnings over the next 12 months. So like you mentioned at the top of the show, there's just this huge disconnect between what Lulu has been able to do in the recent past and clearly what the market thinks they can continue to do.
Sure, but still those recent results, if it's not abundantly clear, they're incredibly impressive. According to one report I saw, 2024, the company had 6.3% share of the about $111 billion just North American sports apparel market, second only to Nike, and that market share has more than doubled since 2017. So that's really good stuff. It's not to steal your thunder, Shawn, but as I read up in prep for our pitch, I couldn't help but notice these results, especially because I pitched Nike, and when I compare them to Nike, that was a company where I was feeling like this might be a good idea. But if you look at the numbers Lululemon is pulling up, together with its brand strength, which mostly is a pitch that you gave me, it looks incredible.
And with the valuation too. Yeah, I mean, I would say the market's caution with any specific brand, and we covered this a bit when talking about Estee Lauder a few weeks ago, is the idiosyncratic risk that a specific brand will flounder and will no longer be considered cool for some reason. And to an extent, this is sort of inevitable in retail, especially for products that are built on premium branding. Maintaining that premium branding forever is just very, very difficult. And it's hard to have enduring competitive advantages in retail because consumer preferences can change on a whim. And as my wife put it to me, where Lulu was kind of a niche status symbol in 2016, now it's so mainstream that everyone owns Lulu and it's not so special anymore. And if it's not special, nor does it confirm the same social status anymore that maybe it once did, the question is naturally, can they still command the same pricing power? Or will they have to increasingly rely on discounts to drive new business or even just to maintain sales in the future? And that, in a nutshell, is the paradox of retail. Only a handful of brands have been able to attain the top ranks of popularity and exclusivity and then actually remain cool for decades. And if you actually try to think about it, what brands have been cool for 20, 30, 40 years, it's a smaller list than you would think. And really only some of the possible examples that came to mind for me was, at least as a former basketball player, Air Jordan felt like one of those few non-luxury brands that has really remained cool and commanded pricing power ever since I was a kid and well before that. The Jordan brand has just pretty consistently commanded a premium to other basketball shoes. But, not every brand can be anchored by the greatest basketball player in NBA history. It certainly helps to have that kind of a tailwind, and Lulu certainly doesn't have an equivalent supporting it. So yeah, I mean, it's hard to feel cool wearing something that everybody else already has. So on the one hand, while a brand wants to scale as widely as possible, doing so can cannibalize their future success. And that's why I call it a paradox of retail. And some of the bears, at least, would say Lulu is appearing to near that threshold if they haven't already hit it. And it's kind of like a bank. We talked about this with Nubank, but it's actually a kind of a red flag to be growing too quickly. And now Lulu's business is hitting some of those bumps in the road. And everybody's wondering, is this just a fleeting pullback before Lulu ascends to the next level of global brand status? Or is this reminiscent of this more ominous pattern in retail where the brand gets too far ahead of itself too quickly? And the customer base gets drawn to emerging but still more niche alternatives like Alo and Viore in Lulu's case.
I don't want to shift the focus too much to another company here, but as you said, retail is an incredibly tough business. There were dozens of brands throughout the last decades that looked like the next big winner at some point. And as your wife said, when the selling point is that you're cool and somewhat niche, then there's a natural limit to what the brand can actually achieve. And why has Nike been there and other companies have not? I always think about that. And to me personally, it's because Nike is the only brand ever to have a foothold in pretty much all of the most global sports. That's football, basketball, American football. There's just no sport where they are not the biggest or at least the second biggest. In my opinion, that's the widest and perhaps even the only sustainable mode that you can have in fashion retail. I went through that entire cycle myself as a kid. I wanted to have the football shoes of my favorite player, and those were always Adidas or Nike. Even today's players at some point were just kids who wanted shoes of their favorite athlete. That's why they're more likely to sign with their brand later on. And it turns into somewhat of a flywheel, perhaps not the one we usually talk about, but it is some form of virtuous cycle. According to McKinsey, sportswear continues to be the fastest growing apparel category worldwide. That naturally introduces a lot of competition. Nike saw that with On and Hoka in the past years. And the more mainstream Lululemon gets, the more they will face perhaps competitors that, just as Lulu once did, start in a niche and then expand into mainstream later on.
I think it's pretty safe to say that Lululemon must continue to introduce new fabrics and technology to retain its market share in its core yoga apparel category, because otherwise it risks losing out to competitors on the margins. That's just a fact. But really, to achieve their long-term growth targets, sales of men's products are going to have to rise significantly from being about a quarter of revenue last year. And that will likely come from expanding Lulu's nascent athletic footwear line, which would put them in more direct competition with your pitch, Nike. And so that's just the problem with exhausting growth in your core product, because now you have to venture into new terrain and take on new and oftentimes fierce competitors in other product categories. So their men's assortment is growing at 14% year over year, and it is primarily focused on apparel rather than yoga. But like I said, they're now branching out into new areas, and that means new competition.
Should Lululemon actually take market share from Nike in terms of running shoes? I definitely need to check my thesis, because that's definitely a bearish sign. And I have a feeling that trying to wrap our heads around Lulu's brand strength will be the defining factor behind our investment decision later in this episode.
I think you're right. And as you know, our colleagues Kyle and Clay did a great episode on Lulu for We Study Billionaires. So why don't we just listen to what Kyle had to say about Lulu's brand strength?
With Lululemon, it's the competitive advantage is quite simple. It's the brand, right? Like you said, they have really high quality gear. It's kind of easy to identify when someone's wearing it. And the brand strength that they've built over time is it's showing how powerful it is now. So Hamilton Helmer points out in his book, 7 Powers, that, quote, branding is an asset that communicates information and evokes positive emotions in the customer, leading to an increased willingness to pay for that product. So he further breaks that down into 2 distinct sections, which are 1, effective valence, and 2, uncertainty reduction. So just in case you get confused by those terms, effective valence is what you think about when looking at a popular brand like Coca-Cola. So Coca-Cola's entire premise is based on the product evoking a positive emotion from their customers, which is why their advertising has always been kind of geared towards, evoking that positive emotion. So because of the strength of the brand, people are willing to pay more for its products than a competitor, because we know specifically what we're going to get when we drink a Coca-Cola. So, for instance, I can go into a Safeway and I can buy Coca-Cola, or I can buy a Compliments branded Coca-Cola. And because Coca-Cola has this brand that it's built up now over 100 years, it can charge a higher price than a competitor without losing any market share. So let's loop this back into Lululemon. Lululemon has been around since 1998. So, obviously not quite the same tenure as Coca-Cola, but it's been around for a long time. And the brand is very, very strong.
Kyle mentions Coca-Cola there, and I can't help but ask, since Coke is a universal brand, how Lulu stacks up globally in your view. I'm sure it's not as popular in Europe as in the US, but it seems to be more popular in China, which, of course, is this huge market that plays a huge role for every brand that wants to go global.
Sales outside the Americas accounted for just 25% of Lulu's total business in 2024, but that was up from 16% 2 years prior. And as you alluded to, the brand has gained a lot of traction in China in particular. So correspondingly, the company reports its sales by geography as the US, Canada, Mexico, mainland China, and then the rest of the world, with China now surpassing Lululemon's home country of Canada at 13.3% of sales, becoming Lulu's second biggest market. And Lulu's store count is on track to rise 75% this year in China from 2022. So obviously it's a market they're betting heavily on. And I think mainland Chinese sales have risen 40% year over year. And so from what I've seen, some analysts and management think half of the company's sales within a decade can come from overseas, at which point we would very much call Lulu a global brand. And what's interesting though is that I don't think Lulu has generally opted to lower prices at all in the markets it's entered outside of the US. So even in these lower income countries, it's even more of a premium product and status symbol. And prices on average are higher in China for Lulu products. And that could actually help balance out Lulu's business as it becomes a bit more mainstream in North America, assuming that it loses some pricing power to the Vioris and Athletas of the world. It's so hard to find like-minded folks who speak the language of value investing. I know most of my friends and family are tired of hearing about my stock picks, so that's why we created the Intrinsic Value community. It's a vetted private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections. After a certain point, reading yet another value investing book only helps so much. Beyond actually getting my feet wet in picking investments, nothing has helped me more than getting feedback from a peer group of passionate investors who have supported my investing journey over time. From community debates about investment opportunities to calls with industry experts who share their unique strategies and insights with our members, it's a special group that I couldn't be more grateful to have been a part of. Spots in the community are limited though, and our latest cohort of 30 members filled up lightning fast, and our upcoming cohorts will probably be even smaller. If you want to take the next step as an investor, then go ahead and join the waitlist for our Intrinsic Value community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. What do you keep in your cupboards? If the last few years have taught us anything, it's that food shortages can happen fast. Empty shelves, inflation, supply chain failures, we've seen it all. I remember walking the nearly empty aisles of our local grocery store in 2020. It was a scary feeling that I'll never forget. As is true in investing too, it's best to be prepared, not surprised. Don't rely on grocery stores who always have what you need. A Harvest Right home freeze dryer can help you prepare for minor or serious food shortages. And with a freeze dryer, you can preserve your favorites. Freeze dry meals, snacks, fruits, and even ice cream, so your family always has real food, no matter what happens. The best part is it's affordable and easy to do, so stock up now while you can. It's a simple, affordable, and tasty way to secure your food supply for the future. With a Harvest Right freeze dryer, you're not just storing food, you're protecting your family. It's peace of mind. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Hey guys, this is your host of the Intrinsic Value podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
I must admit, and I already told you that offline, that I don't recall ever seeing anyone wear Lululemon. Now, I might just not be good spotting at it. That could totally be the case, but it is safe to say that it's just much less popular in Germany, and I think probably in Europe as well, just generally. I've also visited their store here in Hamburg, as it is convenient located close to my home, and it was quite empty. That doesn't necessarily mean anything, but even online, you see them use discounts, and they're mostly about 30 to 50%, so quite significant. It might just not fit the European fashion style, or perhaps you're also just behind, and in 5 years they will be over here. In the US, you do mention that you're just a lot more athleisure focused, but if it's actually more popular in China, I guess the European market doesn't really matter anyway. Would you say the opportunities overseas, and especially in China, are the biggest part of a bull case for Lululemon?
Well, Daniel, if you want to see some people wearing Lulu, I would say keep an eye out for American tourists in Germany, because that's probably where they would be. But yeah, I mean, the overseas picture it's a huge part of the story here. And even if sales stagnate in the US, a second wind internationally could help the company to continue to sustain the really impressive growth that Lulu investors have gotten used to without that growth necessarily coming at the expense of profit margins. And I mentioned this a moment ago, but just to hit the point home again, I was so surprised to learn that according to Lulu's CFO, China is their fullest price market, meaning it is the market where they use the least amount of markdowns to drive sales, which is, I guess, in pretty sharp contrast to the data points you just listed, Daniel, about how they lean more heavily on sales in Germany. So that is, again, the total opposite of what I expected and makes me so much more optimistic about the company's results continuing to improve as China makes up a bigger part of its business. Because, usually it's kind of almost a cliche at this point to say that, international growth in China is going to be the turnaround story for XYZ brand. And people usually ignore that the unit economics are not nearly as attractive. And while Lulu is already showing that they can grow, so it's not hypothetical, they're very much growing in China. And like I said, the unit economics are pretty attractive there. And the other thing I'll say, what makes me bullish is that despite having many rivals, Lululemon's productivity, again, just stands out in the sportswear space. There's really nothing like what they're able to do. Its sales per square foot were nearly $1,600 in 2024. So they squeeze a lot of juice out of their retail footprint. And those retail footprints tend to be in pretty hip, popular areas. So think high-end, top-tier shopping malls or prime real estate in the most bustling parts of cities. That is really great positioning for the brand, but it's also expensive real estate. And there's only so much of it available. So that is kind of a limiting factor on Lulu's growth. They kind of have to patiently wait for that desirable real estate to become available so that they can lease it in many cases. And as I said, Lululemon has a big opportunity in mainland China, and China is already the second largest sportswear market in the world.
It definitely speaks to just the brand positioning in China that Lululemon has if they don't need to discount. So people definitely are seeing that as perhaps not luxury, but especially, or at least a premium brand for sure. And also about the real estate, that's true. The store location here is pretty nice as well, right in the city with all the other big fashion brands. And if you're quite bullish on the outlook, especially in China, then where do you see the bear case? What is the big problem that could hang over Lululemon in the long term?
The bear case is largely that competition is strong in all of Lululemon's key apparel categories, from Athleta to Viore, Alo, Under Armour, and even Nike, which is improving its competitiveness through a partnership with Kim Kardashian's Skims brand. There are a handful of companies trying to chip away at Lulu on the margins in yoga apparel, but also in these adjacent areas like sports bras, gym shorts, t-shirts, lifestyle fits outside of the gym, that kind of stuff. Athleisure, as we might broadly call it. And all it takes is a stumble with a new product launch or some scandal, which Lulu has had a few of in the past, and that market share can be eaten into relatively quickly. And on that point, bears would highlight that Lululemon's sales growth in the US has slowed, not just due to the competitive threats I mentioned, but also due to Lulu's own missteps. And now it could be further negatively affected by tariffs and the economic strife brought on by trade conflicts, where not only are you maybe having less cross-border trade, but maybe you have people protesting American brands, that kind of stuff. None of that's going to help Lulu's international plans. And at the same time, Lululemon is expanding aggressively in countries in which awareness of its brand is relatively low. So it may not have as much success in these regions as it had in North America, or at least there may not be as big of a runway to grow internationally without spending a ton of money on marketing to get their reach to similar rates of market penetration as in North America, if that's even possible. So I have trouble believing it, but management claims that Lulu's brand awareness in its core market of the US and Canada is still only 40%. So if you think that's possible, that does imply that there's still considerable room for growth, even just in the US, as they get more and more people familiar with the brand. So I would love to know the threshold they use for how they define that brand awareness, because to me, I feel like everyone I know, of course, knows Lululemon, but maybe I'm living in a bubble.
I'm the worst judge of it, but from whatever you tell me, this just couldn't be. I mean, sometimes you read these statistics and feel like this just can't be true. It reminds me a bit of Peter Thiel's strategy for undermining your market power when you're a monopoly. just expand the market size so far that your share looks small. And in this case, it might just be talking to investors and saying the US target audience is actually not as saturated as you would think. This suggests that there's still a huge untapped market, which of course would be interesting for all possible investors. But I personally doubt anyone would give up their Harley Davidson leather jacket to put on a Lululemon sweater. But something else I wanted to ask you about, and we talked about this with Nike a bit, is their DTC strategy, DTC versus wholesale. How does Lululemon primarily sell its product? Is it mainly in their own retail stores, online? How do they rely on chains like, I don't know, Dick's Sporting Goods to sell much of their apparel to the end customer?
It's a great question. And I can't emphasize enough how important it is to think about product distribution in retail. As you know, Daniel, it matters so much more than you might think for people who have not invested in retail before, but it really does matter. And unlike many of its competitors with large wholesale operations, Lululemon generates less than 10% of its sales through third-party retailers, which are mostly these specialty yoga shops and similar kind of stores. So the company mainly sells its merchandise through these company-owned, full-price physical stores, and then also with e-commerce directly through their website. And you can contrast that with Nike, which wanted to go more DTC, but that ended up completely derailing the business. And now they're retreating back to selling wholesale to retailers. And in part, the difference is that Nike is more of a ubiquitous brand, like a Coca-Cola, that customers have been conditioned to expect to be able to purchase everywhere. You don't think that you have to go to a Nike store to buy Nike. Whereas Lulu has historically been seen as this very specialized and even aspirational lifestyle brand, where if you want their products, you got to go directly to the source.
It's so hard, to go from being a mass market product to being a premium DTC product. It doesn't work. And Nike, unfortunately, has been one of those companies that has to learn that the hard way.
They learned it the hard way, and it's a discussion for another day, and people can go listen to our episode on Nike, but they're trying to turn that around. But if we look at Lulu, they've always been DTC focused, and they have been building the brand status to be able to draw people specifically to their stores rather than, I don't want to say cheating, but relying on the Dick's Sporting Goods of the world to handle selling for them. It's a very tempting way to quickly grow sales at the long-term cost of the brand. And so this DTC model, where they're selling directly from their own stores, that gives them so much more control over pricing, discounting, their own expenses, product assortment, and marketing, and these touch points people have with the brand. Whereas Lulu's competitors, if they're selling wholesale through these diversified retailers, they lack the same level of control over the customer experience, which shapes their brand perception. And then also they, of course, just have to share some of their margins with retailers too, which makes the business less profitable. And as we've seen with Nike to some extent, a wholesale strategy can put brands at a greater risk of losing control of customer perceptions over time. And I mentioned earlier the paradox of retail and how popular things go mainstream and they lose their luster, and then they have to rely on discounting as the brand kind of stagnates, fades away, or needs to be rejuvenated in some way. And the pressure to discount is even greater when you're competing for shelf space at a place like Foot Locker or Dick's. If they can't move your inventory, then they're not going to carry it. And that incentive structure is partly why I say that relying on wholesale can be at odds with having total brand control, especially in contrast with Lululemon, which can afford to be a bit more long-term minded in their brand because they have such control over their distribution. And so, not to say that in all cases one is better than the other. Nike clearly had success with wholesale for a very, very long time, generated very impressive excess returns on capital. So it really just depends on the brand strategy and whether you're trying to be a premium brand or not. For more premium brands like Lulu, which does command a premium, literally, to Nike products, I think it's just much more important to control all your products' touch points with customers. Point being, competing brands may lose their status if their product is discounted or sold through struggling diversified retail stores.
Totally. I agree on the advantages, but going DTC, just as we said, takes a lot of brand power and consumers need to be used to it. You just mentioned it. I believe part of what caused Nike's DTC failure is that consumers were conditioned over decades to get Nike at pretty much every retailer they can visit. And on the point of brand power and pull, what makes me a bit nervous about Lulu is this big question mark of whether they will lose a bit of social status, which seems inevitable eventually because of how competitive retail is, and especially has become in the last probably decade or maybe 2 decades. So it's a question of whether that's already happening, or is it 2 years out, 5 years out, or even more than a decade out, which would be probably a bold scenario in this case. But once that pricing power cracks, it could be really devastating for the business. For example, on Slack just the other day, you showed me that by just quickly Googling women's running shorts for sale, you found what looked to me basically to be the same product, just basic running shorts. And yet at Nike, they were on sale for like $18, while the Lulu pair was listed at $78. I'm amazed that they have been able to command such a high premium for so long. But again, I just don't know how long that can sustain. If something else arises that is being seen as cooler or anything like that. So my question for you is, how much of that price difference is just paying for a brand with more status, and how much of it is due to Lulu actually being a functionally better product?
There are some folks who really drink the Kool-Aid, as I say, about how great Lulu's product quality is. And don't get me wrong, it's very good. But if I'm being honest, I would think that maybe 90% of that price differential is purely from brand status. And just anecdotally, I know I would pay a premium to wear the same shorts with a Lulu logo over a Nike logo. But it's a great point you raised about whether the differential has gotten too extreme. Maybe Lulu will always be a premium brand versus Nike, but if they have to lower prices to $15 to drive someone to buy Lulu shorts over Nike, which is selling for $20, then that's going to be a big problem for their profit margins and for returns going forward. And I should say, though, Lulu's fabric quality, this is not all fluff. I mean, this is not just a marketing gimmick. Its signature Luon fabric was developed 2 decades ago and was trademarked in 2005. And it consists of a greater amount of nylon microfibers than a traditional polyester brand, making it a much higher quality product. And Lulu has produced several other very impressive performance fabrics, some of which are also trademarked. And its apparel really is designed to be bacteria and smell resistant, feel great, and also to be able to survive many washes. And again, I can attest to that. I mean, this is good quality stuff. And there's something genuinely special about the quality. I should say, I don't think I've ever had any other clothes like my Lululemon clothes. There really is something differentiated about it. But correspondingly, the material in its apparel is significantly more expensive than in traditional athletic shirts and pants. So those Lululemon shorts that we looked at were probably dramatically more expensive to produce than the equivalent Nike ones. And I think this higher price at Lulu, of course, partially accounts for the fact that there are higher input costs. The reality is that Lulu's competitors broadly sell apparel with cheaper materials at lower price points, but in a weaker economy, maybe that stuff is good enough. Maybe people are fine with Nike shorts instead of paying that extra price for some Lulu ones that might last 5 years instead of 2 years. So I would summarize my view as saying that I simultaneously think that Lulu's brand is durable enough to continue commanding pricing power. And also at the same time, the products are literally higher quality and on their own should command some sort of premium, even if the Lulu brand for some reason was seen as being less cool than it currently is.
You know, I would hope that in a recession, people are okay with wearing Nike if it still puts food on the table instead of Lululemon. Now, I still got to feel like I got to try this stuff for myself. Maybe you can advise me on, what piece of clothing I should get to try Lululemon. But my next question then is about their marketing strategy. It's not enough to have a better product. You also need to market it to customers. So how did they go about it? How are they communicating this superior quality to the world? Is it mostly word of mouth? Are they spending a lot of money on marketing? How are they doing it?
They've pretty consistently shown that they can sell merchandise in high volumes, even though the company only spends about 4 to 5% of its sales on advertising. And for comparison, most of its competitors spend 8 to 13% of their annual revenue on marketing, which is structurally why a brand like Lulu can be much more profitable. And in contrast to Nike and Adidas, Lululemon's online and TV advertising is pretty limited, clearly. So it's fair to say that they've relied much more heavily on word of mouth. because their athletic sponsorships are a very small but modestly growing part of the advertising strategy. And instead, they've chosen to engage in much more personal forms of marketing, such as their seemingly ubiquitous reusable shopping bags, which I swear I see every time I leave the house. I see somebody carrying a Lululemon shopping bag, or by even offering yoga and fitness classes directly within their stores, which, brings people in. You come in for Sunday morning yoga and then you leave with a $120 pair of yoga pants. So the classes are popular, and I think they increase customer goodwill and encourage loyal customer visits to the store more frequently. And that's just a win-win for people to feel like they truly are a part of a community when they wear your brand. It's not just something with a logo, but it's the place I do yoga at every week. And somewhat famously, they have focused more on sponsoring local yoga and fitness instructors who they call ambassadors that then go about promoting the brand. That's been part of the word of mouth strategy. They embrace this influencer model pretty early on. And these are mostly smaller scale influencers. So they're not paying Kim Kardashian for a promo like Nike's doing. And our colleague Kyle, in a past life working in the fitness industry, he was actually an ambassador for Lulu. And so the idea here is being, if you see your instructor at the gym wearing Lulu, you might be even more likely to admire the product and buy it than if some celebrity endorses it, because obviously the connection is even more personal. And it's not the deepest moat I've ever seen, but I do believe the firm has local connections to its customer base that aren't just promotional gimmicks. They're actually legitimate and give them some loyalty that other apparel retailers simply do not have. And that's why they're able to pull so many people directly to their stores to drive sales. And as such, I tend to view its physical stores as a strength for the brand and necessary for the brand, as opposed to being weak points that generate a lot of costs, which is usually what we would say for a brand that has a lot of DTC physical locations. It's kind of a point of fragility and vulnerability for the company.
I would be interested in seeing how this develops over time, because as long as you're a niche brand, I think this form of marketing is pretty much the best thing that you can do. But when you also go and try to sell sneakers to people, right, and just go out of your way and expand your business, you just have to speak to different people. I mean, if you look at the story or the history of Nike, they at some point were also niche, and they went to track fields, sponsoring people there, giving away their shoes, kind of like that. And over time, the spectrum of customers just widens so much that you have to advertise just wherever you are. And perhaps that's how Lululemon will do it at some point, but probably that's bullish, because it would mean that the brand is getting significantly larger than it is today. But you just mentioned moats, so let's talk about moats. What moat does Lululemon have, if any? How wide are they beyond just the marketing you just mentioned?
It's hard to say that Lululemon has any moats in the classic sense beyond just the intangible value of its brand. And I don't think they, for example, have a low cost of production advantage, nor does it even really have a ton of sway over their suppliers. Their products are sourced from about 52 manufacturers and 67 fabric suppliers, nearly all of which are in Asia and susceptible to tariffs. And they also supply competitors as well. They don't have exclusive production relationships with these companies. So Lulu is probably an important customer for them, but I would guess that Nike has much more leverage in being able to push suppliers to absorb costs from tariffs, because Nike is a much bigger part of their business. And the thesis here, though, doesn't require Lulu to have extremely deep moats beyond just their brand. I mean, brand strength plus continued operational excellence, I think that's all that's really needed here to drive great returns from what is a really, really low valuation for a company of Lululemon's quality. And so the stock has recently lingered in this $230 to $250 range, where its decline on the year is 30 to 40%. And management is now lowering its full year earnings per share outlook by about 2.5%. And that hasn't helped. But also, you're revising down expectations, which then makes it easier to beat expectations down the road. And so the market has not digested what I would say is this modest cut to the outlook very well. And I think this has brought the bears out of the woodwork who love to express their longer term fear that Lulu is something of a fad and its popularity will fade with time, like the American Eagles or the Abercrombie and Fitches of the world. And creating this dreaded flywheel of retail brand destruction that leads to flat or declining sales, excess inventory, and price cuts that ultimately destroy margins. And that's how many people see the end state, the terminal value being for most retail brands. And there is certainly more examples of that happening than not. But I do think that to some extent, this ignores that Lululemon's products are genuinely better quality and more functional than most others in the market. So it's less a stylistic fad and more the highest quality producer in athleisure. I mean, Lulu has been, every time I've gone to the gym for the last decade, Lulu has been an enduring part of the apparel that I see. So it's hard for me to call it a fad. A lot of these fears started to emerge for the stock in 2024. And that's when it really began to plummet, due really to the worry that its business in North America at about 70% of sales at the time was going to be adversely affected by rising competition. And then these possible changes in consumer tastes where maybe people are moving away from athleisure or they're moving to more niche athleisure brands. Brands like Alo have unequivocally put pressure on their sales. There's just no doubt about that. Before 2024, I had never heard of Alo. And now I actually own some Alo stuff myself, and I feel like I see it everywhere. So it has emerged as almost the new Lulu in some ways, and that gives me pause.
It does sound, though, rather than being a story of Lulu's brand collapsing, this is more about the stock being priced for perfection previously, while the underlying business is actually, from a high level, held firm. Mr. Market's narrative has shifted, and the stock has swung from being clearly overvalued in hindsight to now trading at what is almost a distressed level, I would say, for a company of Lulu's quality at least. Yet there has been this huge pendulum swing, the stock's PE ratio, and it seems all the more crazy when you realize the earnings per share have grown by more than 20% since the stock first began hitting air pockets. It's not like the fundamentals have totally fallen apart. So there's a pretty good case to be made that sentiment has gone from one extreme to the other over the last 18 months.
I agree with you, Daniel. And something that gets me bullish on the underlying business is the fact that Lululemon has arguably one of the most loyal customer bases in all of retail, with its percentage of repeat customers being 13 percentage points higher than peers like Alo after 8 quarters. And within a year of first buying a Lulu product, 44.7% of those customers will return and buy another, versus an average of 32.6% for the broader industry here, which includes companies like Athleta, Viore, Abercrombie, Old Navy, Hollister, Banana Republic, Urban Outfitters, and a handful more. And 10 quarters from an initial purchase, almost 60% of shoppers return to Lulu to buy more. So again, that really epitomizes why I say this brand truly resonates better with people, and people genuinely find it to be more high quality. And that's why they're willing to come back and continue to pay a high price for new stuff after having owned it for a year, 2, 3 years previously.
These numbers sound incredibly promising, but to play some more devil's advocate here, and I think that's kind of what I'm here for, are these numbers kind of looking like the numbers of a brand that is at somewhat the pinnacle or maybe the highest point of demand? If you want to say that, you could perhaps also call it a hype. If I look at the second and the third place on this list, and actually fourth is Abercrombie, which you just mentioned 2 minutes ago, they also have fantastic repeat purchase numbers. They have a very similar profile. They are very young, athleisure-focused companies. The brands that have been successful over many, many decades, Nike, Adidas, and H&M, naturally have lower scores here, but they are on these lists for the longest time. But again, I might also think like this because I haven't experienced the superior product of Lulu. Perhaps this case is very easy and they are just better. Another bullish argument is that right now isn't the first time that the markets have lost faith in Lulu, only for the stock to pull off an even greater comeback later on. It happened at least twice before, if I'm not mistaken. In 2013, something like 1/5 of Lulu's pants had to be recalled for being too see-through. That sent the stock down 50% from peak to trough and ultimately led to the CEO and founder stepping down. But after admitting the mistake, swapping management, and of course fixing the problems, growth resumed within a year and trust was reestablished with its core customers. And then again in 2017, Lulu reported a small decline in same-store sales because its core assortment of products had gone a bit stale and it just wasn't resonating well with much of the target audience. The stock dropped 35% from its peak, and Lulu just continued to focus on investing significantly into new innovative styles. And it also began pushing hard into men's products, which is also part of the strategy now. And by late 2017, early 2018, growth had surged again, and the stock has obviously kept chugging along. So just with that track record, it's hard not to be impressed by Lululemon's resilience and wonder if this is not also just a passing market freakout or something more chronic.
What really powered the stock higher was in 2019 when CEO Calvin McDonald unveiled what they called the Power of Three growth plan. And that aimed to double men's, double digital, and quadruple international revenues over 5 years. And as McDonald proudly pointed out, the company hit all of those targets early, so just 4 years later. And then that's why they released this revised Power of Three ×2 strategy that I alluded to earlier. And this time, it looks like Lulu's going to fall a little short. So they kind of shot themselves in the foot. But I respect the ambition. If you zoom out, that's pretty good stuff. And so they set expectations really, really high. And when they delivered, the market fell in love with the stock and pushed it up to 50, 60 times earnings. And that has, I think, contributed to this really harsh overreaction, in my opinion, given the outlook that they've now delivered being a little bit more conservative.
I like ambitious management, but just from a market perspective, it's probably not smart to set guidance so high, or at least expectations, that at some point you just have to disappoint them, right? And if I'm not wrong, McDonald actually came from Sephora, right? A company that we know because of your LVMH deep dive.
He did. And he said, though, that running Lulu is his dream job because fitness and health are passions of his. So I don't know, maybe that's true. But it is interesting to have a man at the helm of a female-led brand. And beyond his qualifications for the job, I do think, especially given the timing of when he joined, it does reflect that the board really is looking for someone to turn Lulu into as much of a menswear brand as it is a women's wear one. And in one interview, McDonald did say, our men's business is 25% of our sales in the US, and awareness is in the mid 30% range. As the brand grows, as the assortment grows, we're growing away from a yoga brand for her. So in the US, the opportunity is to continue to drive awareness as a brand for him. And so I'm trying to think of when I first got Lululemon, probably 2021, 2022. So I fell exactly into their strategy around that time of appealing to more men. And from what I can tell, that has largely meant a push into footwear, where I feel much less confident in any advantages that Lulu may or may not have, but it has created a new opportunity in resonating with women too. And looking at footwear for men, they discovered that women's athletic shoe designs are historically based on a man's foot. And so as McDonald put it, other shoemakers assume that the feet are the same. And because we're obsessed with science and feel, we know that the feet are not the same. There are significant differences between the width and forefront of the foot, heel, pitch, and angle, and the narrowness of the back heel. And because of that, we delayed the launch of men's so that we could launch and be the first lineup of women's performance footwear designed on her foot.
Wow, I didn't know that. I would be kind of surprised if all of these bigger brands like Nike, who, create shoes for the best athletes in the world, have not yet figured out that they should create women's shoes differently. But you never know. I won't hold my breath waiting for Lulu to displace Nike or Adidas in footwear. But I appreciate the ambition, right? All in all, I think it's a pretty interesting thesis that you're outlining here. I might sound a bit more skeptical at times than I actually am. I just want to make sure that this isn't too good to be true, that we're not missing any alarm bells that better explain why the market has soured so dramatically on Lulu. Because if you just look at the numbers, they're insane and they're almost too good to be true.
It's so important to not just take narratives at face value, which is the one thing we try not to do on this show. So I appreciate you mentioning that. And it would be really, really easy, but also lazy to just think, oh, I'm sure Lulu is this really well-run company that will continue to do well for reasons I don't totally understand, because it's such a popular brand and the results have been great historically, and we're just going to draw a straight line and extrapolate for it. And that's just not what we want to do. We need to actually dig in a bit behind the scenes and see what the numbers are like truly to best understand reality. Otherwise, it's so tempting to get mesmerized by gut feelings and these stories from charismatic management teams or borrowing conviction from other people, which can be dangerous. So as I was looking to understand the picture of the business over the last few years, one of the things that I looked at, which is especially important to do for a retailer, is their cash to sales ratio. And basically, as the business has grown, you're wondering, is the company generating and keeping more or less cash on hand as a percentage of their total sales? And cash is, of course, the lifeblood of the business. That's what they teach you in any Finance 101 class. So if a company is growing unsustainably or unprofitably, one thing you might see is its cash as a percentage of sales falling significantly over time. And that is actually what we've seen with Lulu. Their cash to sales ratio has declined from a peak of 37% in 2017 to just over 12% today. That is a massive swing. And other than this 1 year blip in 2023, it's basically been a straight line down over the last 8 years, which you can see. We're showing the chart on screen right now if you're watching this on Spotify or YouTube. And like I said, it's a straight line down after having previously risen very consistently for a long period of time. So that's the kind of thing you see when you're trying to validate your assumptions about a company that does give you some pause. And it's not necessarily damning, but when I see that, I definitely want to make sure I understand why that is happening and has happened before I go any further.
But this doesn't have to be an entirely bad thing, right? It could also mean that they've ramped up their share repurchases or investments in the business over that time. And actually, if you map it out, it does sort of look like there's an inverse correlation between increases in the buyback yield, so the amount of share repurchases they are doing, and the amount of cash they have relative to sale. It's another question as to whether those share repurchases are being done in a way that enhances intrinsic value by making the buybacks at reasonable prices below fair value. But yeah, it could just show that as the company has matured, they are returning more capital to shareholders and were maybe overcapitalized in the past.
You're a great example of the importance of second and third order thinking, Daniel, because none of these things, there's a story behind every number. And that's a great illustration of not just taking the numbers for what they are, but again, actually trying to understand what the numbers mean and what's going on. And like you said, it's not objectively a bad thing. There's definitely truth to the fact that some of the decline in cash is coming from a bigger buyback program, but that's also not the entire picture. It doesn't explain everything. And so I also dug into their inventory and cash conversion cycle to get more context. And as Lulu's cash to sales ratio has declined considerably, the company's cash conversion cycle has increased by roughly a third since 2019, which is a bad thing. And then it was about 82 days. And now, over the last 12 months, the cash conversion cycle is closer to 109 days. And for anyone who doesn't know, what the cash conversion cycle basically measures is from when you first purchased your inventory, so maybe a new shipment of leggings for Lulu, how long does it take for that inventory to then get sold on average? And on top of that, since most of these purchases are usually made on credit with credit cards, how long does it take for the cash from those transactions to end up in the company's bank account? And so you don't need to have an MBA from Wharton to see this chart that we're showing on screen right now and think, okay, well, that's not very good. If it's taking the company 33% longer to get paid, that is probably contributing to the decrease in cash on hand as a percentage of sales. Again, you're going to want to understand why, because that's at a minimum hurting their cash flow, but it could also show that they're not handling inventory as efficiently. Maybe they're stocking up on stuff too quickly, or maybe as they've expanded to offer more products beyond their original yoga pants, that is tying up capital and inventory for longer periods of time, which can be capital inefficient and just have a real impact on the company's operating results over time. It's sort of a canary in the coal mine, as you might say.
One of the risks of this being when you're keeping more cash tied up in larger inventories, if a product flops or the company misses the mark on this season's styles, now you're stuck with these units that you cannot sell and you're taking up space on the shelves. And you face the dilemma of either having to discount those products to liquidate them, which helps in the short term, but it undermines the quality of your brand long term if customers learn that they can just wait and get your product at a lower price eventually. Apple, for example, famously almost never has sales because that would just dilute the brand's perception. Typically, high quality premium brands don't have to discount. So when you suddenly start discounting a bunch, that's why I say it can slowly shift how the brand is perceived over time and destroy some pricing power over the long term. That's really what we are talking about here when we mention the costs and the risks of having too much inventory. And it has been a characteristic of many fallen angels we covered on this show recently, like Estee Lauder, but also Nike, that had a similar problem. And it's probably the biggest, at least yellow flag that has hung over the stock.
It doesn't sound like much, but over the last 5 years, the size of Lulu's inventories have compounded at a growth rate that is 1% more a year on average than sales. So that does add up to be a fairly significant amount over time, with the point being that total inventories have risen faster than sales. And that is a yellow flag based on everything you just said, Daniel. And the other thing weighing on Lulu on the actual cash collection and payout side of the cash conversion cycle equation is that they tend to have arrangements with suppliers where Lulu pays them in cash after 30 or 45 days. Whereas the Nikes and the Adidases of the world typically don't pay out suppliers until 60 or 90 days. And that extra time holding onto cash before paying it out comes directly at suppliers' expense and finances those businesses. So the TLDR is that as a business, you generally want to collect cash as quickly as possible from your customers and pay out your cash to suppliers at as long of a delay as possible, because you get to hold that cash, use it, or just earn interest on it in the meantime.
It sounds like Lulu has expanded into new product areas, new stores that are probably marginally less successful than previous ones. They've just generally taken on more inventory, and then at the same time, between COVID era supply chain disruptions and disruptions related to the war in Ukraine, I'm sure that has all only complicated their efforts, where maybe you're being a bit more aggressive in ordering inventory when you can, because you don't know when the next crisis will come and make freight or production costs just much higher. For example, we saw imports at retailers in the US surge in the first quarter of this year as companies raced to stock up on supplies before tariffs actually went into effect. And that, of course, is going to contribute to higher inventories and also worse cash conversion. That doesn't explain the entire picture over the last 5 years, but we have had an abnormal amount of these major disruptions since 2020 that are very different from anything that we've seen in the years leading up to 2020, honestly, which is just to say, to be fair, comparing the cash conversion cycle for Lulu in 2025 versus, say, 2018 is not an apples to apples comparison for a few reasons. And then on top of that, Lulu doesn't have favorable payment terms with its suppliers. So I did just want to quickly ask you about why you think that is.
I chalk it up to a few reasons, and we talked about this briefly earlier, but Lulu's suppliers have a good bit of supplier power from a Porter's 5 forces perspective, to get a little academic for a moment. And Nike ships probably an order of magnitude more products than Lulu's unit volume, and the same for Adidas to a lesser extent. That scale lets them threaten meaningful market share loss if vendors refuse to go along with the extended terms that these huge companies demand. And this was a big part of the story for anybody who listened to our AutoZone episode, which is another company that has a lot of buyer power over suppliers. And that has enabled them to have negative working capital, which has been pretty material for their free cash flows and share buyback strategy. So Lulu's smaller order book gives suppliers more leverage to insist on quicker payment, especially because they use these very niche technical fabrics. And that brings us to the point that Lulu doesn't have any patents around for its fabrics. And they have trademarks, but a trademark isn't quite the same protection as a patent. And so in theory, anyone else could produce the same fabric as Lulu. And so I actually think that increases supplier power as well. It's pretty subtle stuff, but nothing happens in a vacuum. And given the prices Lulu can charge and the high margins they have as a result, I think management has historically viewed missing out on a few $100 million in faster payables as an acceptable cost for having a secure, high quality supply chain.
I think that all makes a whole lot of sense. And the only other thing we have mentioned yet was Lulu's botched acquisition of a company called Mirror. They've basically written off that acquisition entirely at this point. And that consumed a good bit of cash and also left a whole lot of wasted inventory to be disposed of. That definitely didn't help the trends in cash conversion and cash on hand that we've been discussing just recently. Maybe you can just tell the audience more about this acquisition or what should have been a successful acquisition.
It was not an inspiring move, and it's the company's only ever external investment that I'm aware of, and it came in mid-2020 when Lulu bought Mirror for $450 million, as you said, and it just proved to be a huge mistake. During the pandemic, there was all this excitement about socially connected fitness and being able to bond with people digitally all over the world while working out. There's this kumbaya feeling, and that was just one of the big visions that made a lot of sense when we were all stuck at home and we were thinking about the world very differently. And the idea was that Lulu supplied the clothes and really the fitness lifestyle, the image that people wanted to project of themselves to the world and embrace, while Mirror was sort of like Peloton. It was a way to do classes from home where you could have, in theory, this virtuous cycle where people paid high margin monthly subscription fees for workout classes at home, which made working out more convenient and enabled them to do more of it, which then drove them to need more exercise apparel that they would then go buy from Lululemon. And I don't think it was a bad idea at all. I mean, it's so easy to be critical of things in hindsight, but I get what they were trying to do. I see why it made sense during the pandemic. And I just think if you have, as a clothing brand, a legitimate chance to capitalize on a potential SaaS business model, I don't blame them for taking it. It was a costly mistake. It was well beyond their circle of competency, but they rolled the dice and it didn't work. That happens. So it really is what it sounds like, though. These mirrors are these big smart TV mirrors that you might install in your home, and they guide you through classes. And the reality is that we found out nobody wants to buy these, especially in a post-pandemic world. And Peloton has had enough trouble selling their bikes, which are actually functional products, right? It's a bike. Whereas a mirror like this, I mean, it could really just be replaced by a computer or an iPad propped on a chair or an even actual smart TV. I know my mom, she airplays her workout classes from YouTube on her phone onto the TV. And so there's this question of, do I actually need a devoted smart mirror to guide me? And so again, it kind of feels more like an idealistic gimmick in hindsight. And as a result, Lulu has rebranded these offerings as their Lululemon Studio, as they call it. And they're focusing more on the app and accessing workout content through there, as opposed to selling the hardware, which they don't sell anymore. So I think that's for the best.
It reminds me a bit of the Roku model. And we saw there just how much unprofitable tech hardware sales can weigh on a business, even though the rest of the business might be great. And without having looked much at the function of these black mirrors, it doesn't strike me as a huge value add, even if you're doing home workouts.
Exactly. And so now Lulu has moved away from hardware entirely and is just doing the bare minimum to honor the mirror purchases and subscriptions that its customers had bought by entering this 5-year strategic partnership with Peloton. And now they have something of a co-branded product together. And it has not been a smooth transition by any means. As a 2023 Forbes article put it, quote, "The shift in the workout vibe from a fitness club atmosphere to a dance club ambiance has not resonated well with the mirror community. Complaints about trainers singing along to music, and particularly about excessive foul language, highlight the disconnect between the expectations of mirror users and the Peloton content." So you're merging these co-branded products together and you're merging these brands, and they're realizing the people who go to Lululemon are not exactly the same people who want to have a Peloton. There are some differences in the workout experiences that those people expect. And one of the big differentiators with Mirror before was the ability to join a class live and actually receive callouts from your instructor who could see you and see what you were doing through a camera on the Mirror device. And that was kind of the value add. And when you move to these pre-taped Peloton classes or classes where you're joining to watch but can't be seen, then there's this question of, hey, why am I paying for this and not just watching a workout class on YouTube for free? And I tried to sign up through Lulu, but everything is just truly being directed to the Peloton app. So instead of a partnership where Lulu is trying to build any kind of enduring SaaS business, it looks like they're really just offloading the accounts for everyone who had bought a mirror to Peloton. And after 5 years, I bet they'll step away entirely, but that's just my guess. So it's too far outside of their core focus on apparel, and unfortunately has done more harm than good.
Given how the mirror experience has worked out for them, I suspect we won't see any more big acquisitions coming out of Lulu for some time. But on that note, how about we kind of bring it all together, as we always try to do, by talking about the valuation. We've both hinted at how we think, just from a PE perspective, Lulu seems very cheap. But as you try to think about the company's intrinsic value and attractive price to buy these shares at, I'm curious where exactly you landed with it.
So where I started was by first segmenting out the North America business from China, and then looking at their sales across the rest of the globe, just to see what kind of growth rates we're working with here. And I was pleasantly surprised to see that over the last 5 years, despite being Lulu's most mature market, sales in North America have grown by 14% a year on average. Well, the average growth rate in China has been closer to 45% and 35% for the rest of the world, which are great numbers. So when I look at my base case, where I have Lulu sales growing at just 4% a year in the Americas and 18% a year internationally, I don't feel like I'm being overly aggressive. If anything, it's maybe a little conservative on the international front. And then I looked at the trends and their operating margins, which have gone up as the business has scaled. But I also try to account for the reality that tariffs at a minimum will limit any further margin expansion for the time being. And more realistically, will probably eat into their margins a bit, or at least if we want to be conservative, we need to account for that. So yeah, I have their operating margins averaging about 21.8% over the next 5 years, which is exactly in line with their average margins over the last 5 years, but down 2 percentage points from 2024. Presumably, at least to me, I expect that would come from these tariffs or maybe higher marketing costs to fend off competition, or a combination of those two factors. And I have to say, for Lulu to have expanded margins through the pandemic and all the supply chain disruptions that came with it, it makes me feel a lot better about their ability to handle this tariff pressure. And when I do all of that in my model, and I also account for Lulu's share count continuing to decline as they keep pretty aggressively buying back shares, as they've done for several years now, you can get a pretty decent approximation of what their earnings per share can look like in 2029. And then from there, it's just a question of thinking about what a fair exit multiple would be. And really, what PE will the market be willing to pay for this company down the road? And of course, we can't know that, but assuming Lulu comes out on the other side of this rough patch intact, and maybe tariffs fall off at some point, or just things don't go as badly as the market currently fears, this stock, even as the company matures, should be trading at much more than 15 times earnings, in my opinion. So this is one of those rare cases where I don't mind betting on the PE multiple appreciating as part of my base case expected return projections. And I suspect as sentiment normalizes and Lulu keeps executing on its playbook, the PE could easily rise from what is one of the most depressed levels it's ever been at to something much more reasonable, like 20 times earnings. That's what we call mean reversion. And this is, I think, a pretty fair expectation when you consider that the S&P 500's average PE is around 20. But Lulu is an above average company in terms of growth and profitability. So it should at least be in line with the market average. So with all of those assumptions, I get a present fair value for Lulu of about $300 per share, with a target buy price of approximately $240 per share, which would give us a 20% margin of safety from that fair value estimate. And well, that is about exactly where the stock has been trading at the time of recording, actually a little below that. So to jump to the punchline, I would be keen to add Lululemon to the portfolio at current prices, but I'm getting a little bit ahead of myself. From current prices, I do think a 13% or higher expected annual return is plausible, though it's just back of the napkin math, really. So it's not a guarantee at all of what will actually happen over the next 5 years.
I don't think there's anything I would have to jump in and say that's too optimistic. Of course, the investment case relies on international expansion, but looking at the actual growth rates versus what you assume, this feels like there is already a margin of safety in those assumptions. And if it achieves this growth and margin profile, the stock is certainly too cheap to trade at 15 times earnings. Having said that, before we commit to a decision, how about we linger on the bear case a little longer and just think more about the risks we would be taking on if we invest?
Thank you for reining in my optimism. Yeah, when I tried to imagine the bear case for Lulu, I looked at some case studies on other brands that had some sort of premium positioning and or functional superiority where the brand then lost its status, to see how that would ripple across sales trends, gross margins, and operating margins, in the hopes that would give me a better idea of what it might look like if, in the coming years, Lulu's saturation of the US market leads to them losing market share and pricing power. And maybe you have some other suggestions in mind to look at, but I looked at Under Armour, Coach, Michael Kors, and Victoria's Secret for this little case study I did. And we don't have time to discuss each one and why I picked them for too long, but in short, these were all very popular brands that saw sentiment around them on social media peak, which you can actually measure with Google search trends. And that led them to do a bunch of things, from offering more discounts and flash sales to leaning more heavily on wholesale, until these brands became pretty significantly diluted over time. And that is ultimately the concern with Lulu, right? That is what is keeping the bulls up at night, is this notion that the brand will take a significant hit and then the business's flywheel will start to slow or spin in reverse, that we're at a peak. And what I found was that in these other examples, from peak to trough, gross margins contracted by about 5 or 6 percentage points on average typically. So that was what I went with in a worst case scenario for Lulu. And of course, that ripples down to affect their other profitability metrics. And the warning signs you'd look for would be something like their inventory turnover ratio declining, which is how long it takes them to clear out their inventory. And actually, like I said, that ratio has been declining for a few years now. They used to cycle through inventory more than 4 times a year, and now it's less than 3, but that has stabilized in the last 3 years. So it doesn't appear that inventory bloat has continued to worsen. And as we know, this hasn't actually resulted in worse gross margins for them. Lulu's gross margins have actually risen in recent years during this time. And we talked about this earlier with the cash conversion cycle too. So it's not a huge surprise. And we have some plausible explanations for why this has happened. So my conclusion is that, at least among the examples I looked at, Lulu does not have a perfect comp, mainly because they are uniquely D2C driven. A lot of these brands seem to really fall apart on the wholesale side, and Lulu has been able to control its destiny in a way that many others haven't been. And I came away still fearful of what a worst case scenario could look like, but I don't think it's quite as ugly as what has happened to Under Armour, for example. And so that impacts just how pessimistic I'm willing to be in mapping out my bear case, with the long story short of it being, I set a floor price of about $159 per share for Lulu's fair value looking out over the next 5 years. And that, to me, is what the stock would be worth today if margins fall off a cliff and sales in North America flatline, while growth internationally is much, much slower than what most analysts expect. And at around $230 per share, we actually aren't all that far from the stock being priced to already account for a significant possibility of that worst case scenario occurring. And there could realistically be 30% more downside. But again, this is, to me, a low likelihood outcome where things would have to take a turn for the worse over the next 5 years. And I can deal with that kind of downside risk to own a great brand like Lulu that I think continues to have really compelling prospects ahead of it as my baseline scenario. And the caveat being that, of course, things could always be worse than I imagined, but still, this all actually makes me feel a bit better about how bad sentiment is around Lulu, since this is a company that is, after all, still growing very quickly and probably has pricing power to protect its margins, at least in response to tariffs. So when I think about everything that could go wrong compared to these peer companies, I don't think the worst case for Lulu is as bad for some of these other names that I mentioned.
And at the same time, it's almost already priced there. At least if you look at the valuation and everything, it doesn't have the numbers to trade at 15 times P, and I think that's basically almost the entire pitch here. But maybe we should also indulge into the bull case a bit more then. How good could things be if the brand outperforms expectations?
I imagine that sales in North America continue to chug along at a mid to high single digit percentage, while international growth compounds at more than 20% a year. Gross margins stay relatively flat at the high levels they've hit the last 2 years. And then operating margins also remain relatively resilient to tariffs in competition. That's my crazy bull case. And then since it's the bull scenario, I accounted for some further mean reversion in Lulu's PE multiple since, as we keep saying, it's at the lowest multiple it's ever traded at. And I just don't think that would be likely to continue, especially not in a bull case, of course. Of course, if everything goes right, the multiple is going to jump a lot and be a tailwind too. So I went in with an exit multiple of about 22 times earnings for my bull case model, which I think is still somewhat conservative when you consider that the company's average PE ratio since 2022 is 37 times earnings and 26 times earnings since the start of 2024 when that sentiment first started to sour. And so with all these assumptions and a conservatively optimistic bull scenario, I could easily envision a fair value for Lulu of about $390 per share, which would imply roughly 70% upside. And so when I see more plausible upside potential than downside risk, and I already feel pretty good about the valuation relative to my base estimates, combined with everything qualitatively we've already talked about on the show today about how great the brand is and the loyalty, that's how I start to feel really comfortable about recommending it to be an addition to the portfolio at current prices.
What sells me on Lulu is the valuation. Of course, in combination with the excellent economics of the business that they have shown now for almost a decade. And when we first look at the numbers offline, when you started researching for your pitch, and we looked at return on invested capital, margins, and all of that, we barely believed what we saw. When a company is consumer facing, it's always easier to get on board of the ideas when you've made a good experience with the brand yourself, or you are a loyal customer for a long time, as you are with Lululemon. That's why I think more highly of, for example, PayPal or Nike than you do. And perhaps you like Reddit or Lulu more than me, but there are companies where the investment case is just so strong that you just see this makes sense. So while I naturally can't have the same conviction in the product that you have, I'm excited when I see these numbers. And I guess the only question that is still outstanding here is, how big do you want the position to be?
I would probably be inclined to make it at least a 5% portfolio weight. I don't think this is one where I think the valuation hedge is sufficient here. The margin of safety is wide enough that we don't need to tiptoe into a 2 to 3% position here, as we've done with some of the more speculative companies that we invested in that have since taken off, right? I think Reddit was a 2% position and now it's almost 5% because the stock has more than doubled since we first entered it. And with Lululemon, I mean, I think that there's real potential for upside here, and the downside seems to be capped in a way that I don't have any hesitations about making it what we might call a core position of at least 5%. We've talked about targeting 20 portfolio holdings total for the portfolio over time, and it's taken us 6 months to get to where we are. So I don't know if we're going to reach 20 anytime soon, but of course that implies on average a 5% weighting. So I think Lulu fits. I think this is an opportunity where we can call it, it's an above average opportunity, but it's an average opportunity in our portfolio, which is in theory a composition of all above average opportunities.
Sure.
So yeah, and if we get a better price on it, I think we could make it a bigger position, but that's my 2 cents.
I totally agree. I think what I also liked, and you mentioned that in your pitch, is that we've already seen Lululemon drop in price and stock price significantly before, but it got not only back on its feet in terms of how the business performed, the stock also got back on its feet. So I think there's even a lot more potential than, I mean, in your bull case scenario, you have a multiple expansion to 22 as a multiple, but we've seen 37 even after Lululemon dropped before. So I think there's a lot of potential there. And as you just pointed out, by now our smallest positions have been the best performers. And we just recently had a fund manager talk to our community and call, and he also said that most of the time people don't really have an idea of what positions will actually be the best performers. I would add to this that our smallest positions just have the most downside risk. So we technically know that the upside risk is probably higher than in some other positions, but we want to cap the downside. And I think Lululemon combines both. We have a pretty capped downside risk and still also pretty high upside potential. So because of that, I'm totally inclined to have a 5% position in Lululemon. And when the price drops, we could buy even more.
Well, I think this is a testament to Daniel why you're a better investor than me, because you're more open-minded to owning companies that you don't tangibly relate to. For me, I have such a tangible element to, like, if I haven't worn the products, I have trouble truly understanding why they're superior, of course, which makes sense. But I think you're very open-minded about companies and brands that are maybe not big in Germany, and maybe you're kind of more used to that on the other side of the pond.
Probably.
But I certainly admire that you are willing to take a risk on a company that I probably have, I won't say probably, objectively have more conviction in than you do, just as a longtime user.
Let's hope it works out that I'm flexible here.
Anything else we should add on Lulu, Daniel, or should we look ahead to next week?
I think it's time now to look ahead and give just some hints for the next episode. And honestly, we will stay in the retail business. I've chosen a company that has come up multiple times now in our comment sections whenever we discuss the hints for the next episode. As I said, it's also a retail brand. And I would say it's famous for mostly one specific product. And I was surprised to see how fast the company is growing, despite only being focused on really one major product. And it is still trading at very cheap multiples. And since you all guessed this company again and again anyway in the comments, I guess that's where I will stop with the hints, and we will just see and find out in next week.
Should be a good one. Yeah, maybe we'll get another addition to the portfolio 2 weeks in a row. That would be fun. We've definitely had more rejections than additions. And I just want to say this one last caveat here. We always like to mention when we own a stock personally ahead of having pitched it on the show. So I'll just say I have owned Lulu for a period of time before I went and pitched Daniel on it. So yeah, I am a shareholder in Lulu. So with that, I will leave us with a quote to close out today's episode. As Starbucks's Howard Schultz has put it, if people believe they share values with a company, they will stay loyal to the brand. In my words here, Lulu has done a pretty incredible job building on their shared values with customers, and that has fostered a uniquely loyal culture that underpins our bullishness, or at least my bullishness, on the brand. So with that, we'll see you back again here next week.
One law in the luxury strategy is that your marketing shouldn't sell products. It should sell a story. And when I walked into that store, I felt the same. I didn't feel like they want to make me sell their product. It was more about telling me who they are and what they stand for. They are not built to maximize profits. Although Moncler stores are actually among the top 3 most profitable in the industry, they are still part of a story-making process, and they showcase how the brand views itself.